Problem is you can never time the market well. And so the message is stay in it, stay diversified in it. As a manager, your job is long-term investment performance. There's no business that helps people more than this business. We help people achieve the most important goals in their lives.
A penny saved is a penny earned. That quote is attributed to Ben Franklin. And that philosophy struck home with Rupert Johnson, who in 1947 named the retail brokerage he founded after Franklin.
My grandfather just was a big fan. I think he's probably the most interesting of the founding fathers.
Almost 3/4 of a century later, his granddaughter succeeded her brother as CEO of the company, now called Franklin Templeton.
No, there was never any pressure to go into the business. I always aspired to be in the business.
In 1957, the firm's funds had $2.5 million in assets under management. Now, under Jenny Johnson, that's climbed to $1.4 trillion.
Today, we're a dominant global asset manager, probably more coverage than anyone else.
Just after Johnson took over in 2020, Franklin Templeton closed its biggest deal ever, the $4.5 billion takeover of Legg Mason. Now, the firm operates in over 30 countries with 1,300 investment professionals. It offers more than 200 investment strategies.
My father always said, take care of the client and the business takes care of itself, right? And so the reputation of the firm and the reputation of the family are very much intertwined.
Franklin Templeton is a much different company than it was 3 generations ago. But then Ben Franklin did say, when you're finished changing, you're finished. Let's talk about this company. People may not be that familiar with it. This company was started in 1947 by your grandfather, is that right?
That's correct.
And was he in the money management business before?
So he had a brokerage business, Johnson and Associates, and he set up a little subsidiary called Franklin Funds. And my father, his older brother, took over the brokerage business, and my father wanted to do his own thing as an entrepreneur. And so he asked if he could run Franklin Funds. It was $2.5 million in assets and a part-time employee was the extent of it. And as he reminds me, it was $10,000 in revenue at the time.
So when you were growing up, did your family say, you're going to be the CEO someday of a money management company that we own?
No, there was never any pressure to go into the business. I always aspired to be in the business. There was only one time where I considered a different career, and I wasn't focused on being the CEO. I loved what I did. I ran technology, I ran the operations. I, kind of came up on that side of the business. And, I think my brother, after 15 years, was ready to do something different. He had an opportunity to be the control person of a Major League Baseball team. I mean, who wouldn't want to do that? And so it was kind of time.
What team is that?
The San Francisco Giants.
Okay, so have they won a World Series under his leadership yet?
They haven't. I was on the board when they won their 3 World Series,
okay.
So I just will put that out there.
Okay. So let's talk about the size of your company and what it actually does. Today, how much assets under management do you have?
We've about, I think, 1.45 trillion.
Okay. And most of what you have done over the years is offer mutual funds, is that right?
Correct.
Now, in the last 10, 20, 30 years or so, a new phenomenon called index funds or ETF funds have come along, and they say, more or less, don't worry about smart money managers picking good stocks. We're just going to get you the index, and you don't need to worry about paying higher fees that mutual funds charge. How does that affected your business?
So, and let me bifurcate that answer. So one is ETFs, I look at as a vehicle. Oftentimes people confuse them and say, well, they're just a passive index, but they're just a vehicle to deliver your investment capabilities. So at Franklin Templeton, our expertise is people managing money. You have a certain mandate and a risk return, and we manage it that way, and we deliver it. We're agnostic to the vehicle in which we deliver it in. So it might be a mutual fund, it might be an ETF. We have 99 ETFs. It might be a separately managed account or a collective investment trust. So that's the vehicle. We're agnostic to that. Now, the passive versus active question, which is sort of your index question, we've just come off a decade where essentially interest rates were 0. You could borrow money for nothing. You didn't get paid to be in fixed income. And so where were you going to put your money? And meanwhile, the government was essentially printing money. And that pushed everybody into the equity markets or into private assets. In that environment, passive funds often outperform in a momentum market. Having said that, as an asset manager, your job is to provide risk-adjusted returns. So, it got to the point where the top 5 companies in the Russell 1000 large cap represented 40% of the index, and had excess returns at the time. But the average investor cares about downside protection too. So a manager, I think at one point, one stock was 12.5% of the Russell, so Russell 1000. So that's a lot of exposure from a risk standpoint. It's a heavy concentration. So as an active manager, you're going to look at that and say, I don't necessarily want to have that. I want a more diversified portfolio. But that meant you probably underperform. But now, when you've seen the market decline, those top 5 declined 24% on average, whereas the rest declined about 17%. So, again, as a manager, your job is long-term investment performance.
Let's suppose I say, all right, I want to put some money in a Franklin Templeton fund. What type of return should I expect on a stock fund? Should I be getting 6% a year, 5%, 8%? What should I realistically expect after fees?
Well, if you look at, I think it's the S&P 500 from its sort of beginning, I think the average return is about 10.5%. The last decade of this kind of very momentum market, it was closer to 15%. The problem is people then start to expect 15%, and I think you take, too much risk for somebody trying to put money away for retirement to expect something like 15%. So I think a pre-tax, 10% return over a long period of time. You're going to have time when the markets go down. But at 10%, the average is probably a reasonable return.
And after fees, something like?
Probably like 9%.
Okay, so that's what people should realistically expect. But in the business that I've been in, the alternatives business, private equity and things like that, they've been getting higher rates of return. You have kind of said, if you can't beat them, join them. Recently, you have bought a lot of alternative businesses. Why did you do that?
Yeah, so I tell people, my grandfather got into the mutual fund business because the average investor could not get a diversified stock portfolio, and it was too dangerous to put, your entire savings in just a couple of companies. So the mutual fund was created to give a diversified expert management at a reasonable price. Today, we have a phenomenon where companies are waiting much longer to go public. And so in 2000, the average company went public after 3 years. Now, companies are waiting 9 to 10 years because there's so much money available in the private markets. As a matter of fact, there are half the number of public companies that there were in 2000, and there's 5 times the number of private equity-backed companies. So just from an investable universe, you look at the private markets, and it's significantly bigger. So the question is, that return that used to be captured in the public markets is now captured in the private markets. But the problem, as is you're really tied up for a long time when you invest in a private equity fund. And so trying to figure out a way to solve the same problem my grandfather was trying to solve, which is how do you bring those returns responsibly, the democratization of the private markets to the retail investors. And I describe it as a bit of like running with scissors. Scissors is a great tool if you use it appropriately. And so we're focused on trying to figure out responsibly bringing it in to the average investor. I always say that that Bitcoin is the greatest distraction from the greatest disruption that is happening in financial services today.
For the asset and wealth management industry, M&A activity was on fire last year. According to PwC, there were at least 296 deals in 2021. That was 50% more than in 2020, and the most since 2000. One of the big deals announced last year was Franklin Templeton's purchase of private equity fund manager Lexington Partners for almost $1.8 billion. This year, the pace has been even faster. Through the middle of May, there were 109 announced deals, 11% more than at the same time in 2021. A couple of the big ones, UBS bought robo-advisor Wealthfront for $1.4 billion. AllianceBernstein paid the same amount for private credit manager CarVal, And Franklin Templeton bought asset manager Alcentra for $350 million up front, and it could pay another $350 million if Alcentra hits certain targets. PwC notes, though, that deal momentum slowed in the second quarter. What to expect for the rest of the year? Jenny Johnson has indicated Franklin Templeton will continue to explore ways to accelerate growth in infrastructure and wealth management via acquisitions. So as we talk today, the United States economy seems to be slowing down a little bit, and some people actually worry about a recession. How has that affected the money management business that you're in? What are your investment professionals telling their clients?
So we have 18 independent investment teams. And I can tell you that our macroeconomists have differing views on whether there'll be a recession, if there's a recession, the depth of a recession. So I'm going to say that it depends a bit on that. But what I look at is we're looking at some statistics on market returns. And in a 20-year period between 2001 and 2020, or I guess 2002 and 2021, there are 5,035 trading days. If you missed the 10 best days of the market, you lost 65% of your return in that window. So the problem is you can never time the market well. And so, the message is stay in it, stay diversified in it, and because too often you see people when the market's gone down, they pull their money out, they wait till the big increase, and then they put their money back in. And so, you just have to be a long-term investor and, stay diversified.
So today, the Federal Reserve has been criticized by some for not raising interest rates quickly enough, and some people say it's raised it too quickly. Where do you come out on what the Fed has done? You think the Fed has done a reasonably good job in dealing with higher inflation?
I think the most important thing for the Fed to do, and they probably could be a little bit better at it, is communicating what their plan is. Markets can absorb as long as they understand and there are no surprises. And so I think the most important thing for the Fed is to communicate their plans as they're raising rates.
Okay. And right now, today, if I had some money, should I be putting it in a mutual fund, or equity fund, a fixed income fund? What's better today, given where the markets are? You think stocks are likely to keep going up, or you think fixed income, because interest rates are going up, are likely to be a better buy for people like me?
So, I think we know that the Fed is going to continue to raise rates. So that's going to make any kind of longer-term fixed income a little bit of a challenge for the short run. The equity markets may go down some, or they may be bottomed. I don't know that any of us know that. We're entering into earnings season right now. But again, I would just say to folks, just have a good diversified portfolio that's appropriate for your risk level and stick with it. And if anything, don't look at it. If you can't afford to be invested for probably a couple of years, maybe cash is a better move right now. But if you can afford to be invested for a couple of years, then set up a diversified portfolio and just don't look at it.
Some people say that one of the best opportunities now is cryptocurrencies, though crypto has had some problems. What do you tell people that say they want to be in cryptocurrencies? Do you offer the opportunity for people to invest in crypto through Franklin Templeton?
Yes, actually we do. So first of all, I always say that that Bitcoin is the greatest distraction from the greatest disruption that is happening in financial services today. So I wish, because every time everybody gets in a conversation about crypto, it leads into a conversation about whether this currency, whether it's Dogecoin or Bitcoin, is of value. Forget that. That's like a religion. You either get a believer or a non-believer, and they're never going to agree. But blockchain as a technology and what it can do is going to be hugely disruptive. So not only is it going to be disruptive on traditional back offices and just create much greater efficiency, but disruption on business models. And I'll give you a couple examples of that. Today you go on Google and they capture 100% of your value on your search via their ads. There's a company that has been set up, and when you use their search engine, they're actually paying you in cryptocurrency for some portion of your economic value that you're bringing to the table. There's another company that wants to be the fastest streaming service out there. So when you're watching the content, so as I'm watching it on my, say, phone, I'm agreeing to let them cache their content on my phone. So now that you want to watch something, it only has to jump from my device to your device. and they're paying me in their currencies to leverage my device's infrastructure. So now I'm not just a client, I'm capturing the economic value as they grow as a firm. And by the way, I've become part of the infrastructure. They don't have to buy as many computers because they're leveraging their client's infrastructure. So the technology enables that kind of disruption. And then, you have new revenue streams, like I think the NBA raised $500 million in selling off NFT video clips. So that's a new stream. I can imagine, we talked about my brother and his role in the San Francisco Giants. You can imagine sports teams, what if you sold 1% of the San Francisco Giants to 100,000 people? And oh, by the way, they get bragging rights that they own it. They own it with their token. Maybe they get special access to the coach who's going to do a post video after the game, right? It becomes a loyalty program.
What do you do about ESG? Are you very conscious of investing in companies that have good ESG performance?
Yeah, well, again, we're asset managers, so we do what our clients ask us to do. But anybody who's been in Europe for any amount of time, and we've been a big manager in Europe for a very, very long time, knows that there is a big push on ESG. And so it's been a big focus of ours. What you have to think about in ESG is you have to first think about how it's risky. What are these risks, the environmental, social, and governance risk to the underlying companies? How are you measuring its alpha contribution to your portfolio? And finally, what is the impact of that on society? And so all of those things are really important. And you see the regulatory environment is mandating that you have this. In the US, they tend to be more focused on what are you saying you're doing, and then prove to me that you're doing it. And Europe tends to be more focused on what is the actual societal impact. But clients are absolutely demanding that you not only report on returns, and we all have a fiduciary duty to have good returns, but also what is the impact. I feel strongly that people should use a financial advisor, because the financial advisor will deal with the emotional difficulty of a market drop.
So let's talk about your own background. So where did you grow up?
Well, I was born in New Jersey and in California in 1973. My Franklin bought a company out in California, and so I moved out to California with the family.
And so you grew up in a pretty large family?
A lot of 7 children in 10 years, yeah, a lot of chaos.
And at the family dinner table, they talk about money management all the time?
No, I mean, as a matter of fact, my mother, after having 7 kids, went on and graduated from Stanford Medical School. And I would say there were way more conversations around the sciences than there were around financial services and asset management.
So when you were growing up, did you say you wanted to do the same, or what did you say you wanted to do when you were growing up?
I, for some reason, always wanted to be in this business. There was a period of time in college where I thought maybe I would become a coach, because I love sports. I was a double major in economics and physical education, and I thought that would be a fun thing to do. And then I decided that I could probably volunteer as a coach.
Where'd you go to college?
I went to University of California, Davis.
Okay, and so after college, what did you do?
I went my father said, if you're going to be in the financial services business, you should probably live in New York. And so I got a job at Drexel Burnham, and I worked in kind of like a trainee program at Drexel Burnham.
And at that time, did you think a woman could ever be the CEO of your family's business?
I grew up in a household where it was viewed that women could do as much as men. As a matter of fact, my father was the first one to hire, we had the first female general counsel in the asset management business. He was obviously very supportive of my mother going back to school and graduating as a doctor. At one point, we had 3 times the number of female women running our investments than the industry did. That's through acquisitions. That has actually declined. We're about at where the industry is.
Did your brother, who you succeeded, and your father, who he succeeded, did they say don't screw up the family business when you got the job, or?
Trust me, you do not want to screw up the family business, for sure. That is, and actually it's why I think that having the family still involved in the business is important. I mean, my father always said, take care of the client and the business takes care of itself, right? And so the reputation of the firm and the reputation of the family are very much intertwined. And so when you feel that responsibility, you make sure you're doing what's right for your clients.
So today, you're happy with what you're doing and being the
CEO?
Love it.
Love it.
And do you think that today this is a job that young women and young men should really aspire to do, go into the money management business as opposed to public service or things like that?
So it's funny, I tell the story about saying to my kids, so are any of you going to follow me in this business? And my daughter, who makes documentary films, says, no, Mom, I want to do something that helps people. I said, are you kidding me? Like, there's no business that helps people more than this business. We help people achieve the most important goals in their lives. And we have to, every day we walk in, and I think that the employees at Franklin Templeton feel this, we walk in with a fiduciary duty and a responsibility to, help a person who wants to retire and be independent financially, or if you have a special needs child and you worry about saving enough money to make sure that that child's taken care of after, or you want to save enough money to launch a business, whatever it is. These are people's dreams, and there's no better business to do this than ours.
So what do you think is the biggest mistake that investors make when they generally look at what they're doing? Your observation would be that the typical, most common mistake investors make is what?
Is they sell low and buy high. The typical investor, that's why I feel strongly that people should use a financial advisor, because a financial advisor will deal with the emotional difficulty of a market drop. When you suddenly look at your retirement account, it's down 25%, and say, don't worry, we're in this for the long run, just stay in. And so it's that's been one of the biggest challenges, I think.
And what's been the best investment advice anybody ever gave you?
Be diversified and stay in the market. I think the biggest issue is people hesitating and not getting in the market.
So I assume, you go to cocktail parties from time to time, you're running Franklin Templeton. I assume people come up to you and say, Jenny, can you give me some investment tips? What should I do with my money? Does that happen a lot?
Yeah, well, if it happens, what I would say is the best thing to do is actually to ask an expert, financial advisor who knows exactly what your needs are. Because, the beauty is people can customize for their personal needs. I don't know what a person's situation is. And frankly, I just managed 1,300 investment people. That's not my expertise.
Well, of this job, what's the pleasure of it? What's the greatest pleasure of running Franklin Templeton?
I think it's this knowing that we're helping people achieve the most important goals in their lives.
What's the greatest challenge of running a company like this?
I think, look, it's hard. My dad has a saying, he says, you either are a tough boss or you work for one. Sometimes you have tough decisions. You have to, terminate people or move them into a different role. And, sometimes a job's grown beyond somebody's capabilities. Sometimes you have to make a decision where you're outsourcing, and those are tough. People decisions are the tough part of the job.
Let me ask you, isn't it really difficult that when your father is around and your brother is around, both of them are CEOs, you've got two family members who are CEOs, and they must know your business pretty well. Isn't that the toughest part of your business, your job?
Oh, I think that's the greatest benefit. When we're making it, we've done, I think, 8 acquisitions in the last, 2 years, and very much engaging in conversations with them about, is this, the right time, here the thinking on it, and knowing that their goal is exactly the same as mine. So any feedback they have, is coming from the right place. So I think it's a tremendous benefit.